This strike didn't just hit Venezuela, it quietly hit the assumptions behind your money. Here's the contradiction nobody is sitting with yet. The United States launches a military strike, captures Nicolas Maduro, and somehow the most valuable part of the country is left standing. According to the content, not a single refinery, export port, or production facility was deliberately destroyed. That is not how accidental wars work. That's how planned outcomes work. And this matters to you because Venezuela isn't just unstable, it's stacked. The facts are explicit in the material. Roughly 303 billion barrels of proven oil reserves, more than Saudi Arabia, more than Russia, more than anyone. But here's the twist most people miss. This isn't easy oil. It's heavy crude, thick, expensive, difficult to extract. The kind of oil U.S. Gulf Coast refineries were redesigned to handle decades ago and never switched back. So when the infrastructure survives, the question isn't what happened. The real question is what was protected, because energy doesn't just power cars. It prices everything you buy, everything you invest in, and everything governments are trying to control right now. The content makes a much bigger claim. This isn't just about oil flows. It argues this moment ripples into gold, silver, the dollar system itself, and a deflationary force that doesn't show up on headlines until it's already baked into prices. That's the risk. And that's also the opportunity. But here's the part nobody says out loud. If this were only about geopolitics, the oil wouldn't matter. If it were only about drugs or diplomacy, refineries would be collateral damage. They weren't. And that detail changes how you should read everything that comes next. Because once you see why this infrastructure stayed untouched, you start to see what this move enables next. Now we hit the tipping point. Because what you're about to hear could completely flip the way you view energy markets. And the piece that's missing from most discussions is exactly what happens when oil flows again. But this time with a different kind of power behind it. The content highlights something the mainstream isn't talking about. Venezuela's oil infrastructure doesn't just feed the U.S. refineries. It disrupts entire systems that have already been built around Canadian oil and its high costs. What's worse, Venezuelan oil doesn't need to be shipped from the far north. It's right next door. The U.S. already owns a piece of this. And once that's flowing again, the narrative shifts. This isn't just about oil. It's about energy costs across the board. We're talking about gasoline, heating, transportation, manufacturing, plastics, petrochemicals. All of these areas are going to get significantly cheaper. And the ripple effect doesn't stop with oil. This cheap energy trickles into everything. So when the content warns about the deflation play, it's pointing at something bigger, a full market reset. That means industries reliant on cheap oil, everything from food production to tech manufacturing, are about to benefit from what we're calling a deflationary shock. But the real twist? The U.S. can't let this play out without some serious leverage on the global stage. Because once Venezuela opens that floodgate, it has the potential to drive global inflation numbers down, leaving the central banks with no choice but to act fast. Here's the claim that changes how you read this entirely. This move wasn't about stopping oil. It was about restarting it under new control. The content gives a concrete detail that matters more than any speech. Venezuela holds about 303 billion barrels of proven oil reserves, roughly 17% of all the oil on the planet. That number alone explains why infrastructure was protected, but the material goes further. It explains the type of oil. Heavy crude, thick, tar-like, expensive to extract, and useless unless you already have the right refineries. Now notice the detail that usually gets skipped. In the 1970s, the United States recalibrated its Gulf Coast refineries specifically to process heavy crude, expecting light oil to run out. Fracking later changed that expectation, but the refineries never changed back because the cost would be enormous. So today, according to the content, roughly 70% of U.S. oil imports are heavy crude, and about 60% of that comes from Canada. This is where the story flips. Venezuelan heavy crude is a direct substitute. Same processing, same refineries, same end product, which means if Venezuelan oil comes back online, dependence shifts almost automatically. No new systems required, no transition period, just a new source feeding an old machine. But here's the part nobody denied. The content includes a direct reference to an official White House post stating that Venezuela would use oil revenues to purchase only American-made products, including agricultural goods, medicines, and equipment to rebuild its electric grid and energy facilities. That's not neutral trade language. That's directional. Factually, what you're seeing is oil flowing out, dollars cycling back, and controlled tightening without a single refinery being bombed. And once you see that loop, it becomes very hard to call this accidental, because if oil supply is about to expand in a controlled way, the next question isn't who wins first, it's who quietly loses. And that's where this starts escalating. This is where things really get unsettling. The next few years won't just be about fluctuating oil prices or the rising cost of gold and silver. The world's financial systems are shifting underneath your feet, and most people won't notice until it's too late. What's really at play here is a reset of the dollar system. The content draws a direct line between Venezuela's oil, gold, and the way central banks are moving away from the U.S. dollar. Venezuela has already joined the BRICS, and as the U.S. tightens its grip on Venezuelan oil, the rest of the world is quietly preparing to hedge against dollar dependence. That's happening faster than you realize. The U.S. is going to be able to control energy prices in a way they haven't been able to in decades. And in the process, they'll use that control to manage inflation and debt. By flooding the market with Venezuelan oil, they'll lower headline inflation in the short term. But here's the catch. Real inflation, the kind that eats away at savings, will still surge. And the wealth gap will widen, with the rich continuing to accumulate assets and the rest of the population facing higher costs of living. You might be wondering, what's my move in all this? If you're serious about navigating this new economic landscape, it's all about understanding where the next shifts will land. The opportunities are massive, but so are the risks. The next step is positioning yourself in the long-term assets that hedge against dollar devaluation. This means looking at gold, silver, oil stocks, and even mining companies. But it's more than just buying those assets. It's about understanding how energy prices and commodity markets will influence the entire global economy in the next decade. And the biggest question of all, are you ready to be on the winning side of this transformation? Chevron, Exxon, and ConocoPhillips, they're positioned perfectly. These oil majors have deep ties to Venezuela and a massive advantage over their competitors. Chevron never left Venezuela during the toughest years. They kept their infrastructure in place, maintaining operations while others fled. Now they're set to reap the rewards of this controlled restart. But don't get too comfortable with just buying the big names. While they will win, the real upside might be in the smaller players, those that can scale quickly as energy costs fall and demand for oil continues to rise. However, selecting the right junior miners is critical. The content suggests looking for those with proven reserves, low production costs, and strong management in politically stable jurisdictions. Here's why that's important. The mining sector is volatile. Yes, profits are going to spike with cheaper energy and higher metal prices, but the risks are huge. Picking the wrong company means watching your investment crash as fast as it skyrockets. The next few years will be about selective positioning, not just blind optimism. And don't forget, this is not a quick trade. This is a multi-year play. The infrastructure won't rebuild overnight. The investment returns from Venezuela's oil return, gold and silver markets are going to take time to play out fully. But when they do, those who position themselves now will be looking at some of the biggest returns in decades. Now, let's zoom out and take a look at what the future holds. The path forward from here isn't clear-cut. There are two possible scenarios, and both carry massive implications for your investments. Scenario 1. is the most straightforward. Venezuela's oil infrastructure gets rebuilt, the flow of crude ramps up, and the U.S. locks in an even more dominant position on global energy markets. In this scenario, cheap energy starts to trickle through the economy. Inflation stays manageable in the short term, but the wealth divide expands as those with assets continue to gain. Gold, silver, and mining stocks continue their upward trajectory, while energy stocks, particularly those involved in rebuilding Venezuela's oil, get massive boosts. The second scenario, though, is the riskier one. As the energy market adjusts, there's the possibility of our political instability, and Venezuela's oil infrastructure might not come back online as quickly as hoped, or geopolitical tensions could disrupt the process entirely. In this case, the timeline gets stretched and the energy market becomes even more volatile. The deflationary shock we're talking about could take longer to materialize, leaving some investments exposed to the wild swings of oil prices and global inflation pressures. This is where everything starts to click into place. You've seen the oil, you've seen the gold, you've seen the shifts, but the real play, the one no one is talking about, is, deflation and how it will affect everything in the next few years. Let's break this down. When Venezuela's oil hits the market again, the result is more than just lower oil prices. It's a deflationary shock to the entire global system. Everything gets cheaper. From gasoline to manufacturing, plastics, chemicals, and even the transportation costs you're paying every day. Why? Because cheap oil lowers the cost of everything tied to it. This includes materials, production, and transportation. As oil prices drop, industries reliant on energy, like manufacturing, logistics, and chemicals, will see a sharp drop in their operating costs. And that's going to lower prices across the board. But here's the twist. This deflation doesn't just benefit consumers in the traditional sense, it benefits the wealthy who own assets. Because while energy costs fall and consumer goods get cheaper, asset prices continue to rise. Stocks, real estate, gold, and other commodities, they'll continue to skyrocket. So what do you get in the end? Lower energy bills, but less purchasing power for anyone who doesn't own assets. The deflationary play isn't just about cheap energy. It's about the collapse of the dollar system. The content highlights a shift to gold, silver, and energy stocks, but the underlying theme is the growing reliance on commodities as the new reserve asset. The trend is already happening. Central banks are doubling down on gold. And as Venezuela pumps oil, that influence will ripple through the global system. Commodities will be the hedge against currency devaluation. And if you're not already making moves in this direction, now's your moment to act. Now, we're nearing the end of this story, but the insight I'm about to give you will change how you see everything that's happening in the world right now. In the next few years, you're going to watch this play out on a global scale. Venezuela's oil isn't just going to flow into the U.S. refineries. It's going to reshape energy markets, influence inflation rates, and change the way the world handles the dollar. What you're seeing right now is just the beginning of the next massive reset in the global economy. And before we wrap up, I'll leave you with this thought. The winners in this new world are going to be the people who take control of their financial futures now. They're already ahead of the curve, and the sooner you start, the better. So if you're ready to make moves, start now. Otherwise, you'll be stuck watching the opportunities pass you by. Do you want to learn more about how to prepare for this shift? Make sure to subscribe for continued analysis and get ahead of the curve before it's too late. All the best as you navigate the new world order.